you're about to start the third leg of this cyclical bull market that started in October 22. And I think this third leg could take us to S&P 7,500, Nasdaq 25,000, Dow 55,000, and the Russell, which is probably the one people least believe, 3,300. When I say bust, as I said, it's basically it's a depression-like feel that happens at the speed of recession. So it's not a drawn-out, decade-long depression like the Great Depression, but it does occur. It does feel like a depression when you're in it, and it probably is over in 12 to 18 months. So it's much faster than a depression, but it feels like a depression.
Hello and welcome to the Achieving Alpha podcast. My name is Steven and I'm the host of the show. Today, I'm delighted to be joined by David Hunter. He is the Chief Market Strategist at Contrarian Advisors, and he has over 50 years experience in the stock market and in the economy. It's a real pleasure to welcome you, David.
Hi, Steve. Great to see you. It's our first time, so nice to meet you.
Yes, really, really nice to meet you. As we just said off air, it's a really interesting time at the moment. There's a lot of stuff happening in the market and in the economy. So we're going to have a lot to talk about today. Really looking forward to our chat. And just as we get started, because as you said, it's your first time on the podcast, I would just like, if possible, for you just to introduce yourself and just explain a little bit more about your experience and in the stock market.
Sure. I started in business as a money manager back in 1973. So a long ways back. I had the advantage of coming into a market that was peaking, the Nifty 50 peak, and then the 74 bear market was the biggest bear market we had post the depression up to that date. So it kind of taught me early on the value of capital preservation, the value of looking at not just the returns but the risks. And then I was in banking for several years. I started in a bank and then moved to another bank, a larger bank, and then managed pension money from there through the balance of my money management career, which was about half of that 50 years. The other half I've spent as a macro strategist. So I was an institutional money manager. I think it gave me a lot of, and I was pretty much top-down money manager, was a top-performing pension manager. And having done that gives me an advantage, I think, as a strategist, is that I did manage money. An awful lot of strategists just kind of came into this as a strategist or moved up from an analyst job. So having run money really makes a difference in terms of how you see things.
Yeah, definitely. When you've managed money, it makes you think a bit more strategically about how things move, right?
Yeah, definitely. Like I said, you really consider the risks before you consider the rewards.
Yeah, definitely. All right. Well, huge amount of experience there. I wanted to just discuss what's going on in the stock market at the moment. Some people are nervous. Some people are battle trodden, so they've been through this a lot of times in the past, so slightly less affected by it. But the Nasdaq is down about 8 or 9% for the year, I think, and the S&P is down about 4.5%. What do you think has kind of caused these dips in the stock market over this year? Which are the kind of key factors that's been driving that? And if you could just kind of maybe give a broad strokes outline of what's happening in the markets at the moment.
Yeah, first of all, the year-to-date numbers are fine, but I think the one that gets the investor attention more is the fact that in the last month, the S&P is down 10% from all-time highs, sure, and the Nasdaq's down much more than that. So I think that really, and I'm a contrarian strategist, and I talk about sentiment all the time. Sentiment drives markets. particularly at the major inflection points. We're not just some people are bearish. We've got very heavy bearishness out there right now. People react to the tape. The tape's been down for the last month and down a lot more than most people thought it was going to be, including me. So what you see in a reaction like that is that people go with the tape and they start talking about even lower numbers. So right now you've got people assuming this market has farther to go, and some people think a lot farther, and you hear a lot of talk about we've seen the top of this bull market and it's going down 20, 30, 40, 50% from here. So that's where I think sentiment is now. Obviously there are some people out there, including me, that are still bullish, but there's an awful lot of negative sentiment. And as I say, markets are built on wall of worry. So when you get that build up in bearish sentiment, you get a wall of worry that provides the fuel for the next advance. I personally believe we saw the lows, a couple weeks ago on a Thursday, and then retested them yesterday. Made minor new low in the S&P. I think it was 5,500, and it went down to 5,490. So you made a minor low in the Nasdaq. You made a much deeper low, but still within a couple percent. And that's a very typical retest. People think retest means it has to stay above the previous low. Retests will oftentimes undercut by a little bit, scare people, say, oh, it broke, here we go, and then reverse. And that's what we saw yesterday. So my guess at this point is that we had a successful retest. We'll need more time to know that for sure. But I think that's what it looks like right now. It was up on the day yesterday and up on the day today. So I think that's a good sign. And the reasons for that, obviously, is a lot of uncertainty. Some of it caused by Donald Trump, with talk about tariffs, and that scares people. People remember the tariffs were a big, they remember from all their education that tariffs were a big cause of the Great Depression back in the 1930s. Most of the street is believes in so-called free trade. What Trump is trying to do, though, is level the playing field. He said we've not been in a free trade world for a long time. We've given away our store. Meanwhile, we can't sell into other stores because all the other countries have tariffs. So he's obviously tomorrow talking about reciprocal tariffs, and meaning that we're going to institute tariffs, and if you don't drop yours, we're not dropping ours. And that scares a lot of Wall Street because typically everybody loses in that kind of a game. But I think what we'll see is at some point cooler heads will prevail, and we'll see some lessening of trades overseas, which is really what he would like to accomplish, I think. And some of our tariffs will stay, but probably not at the extremes that everybody's worried about. So uncertainty is kind of the enemy of markets. And certainly until we see this thing, how it all shakes out, that uncertainty kind of hangs over the market. But markets are discounting tools, and markets discount the future. So, there's an awful lot of information out there that people are in the aggregate putting together. And I think what you'll see is that we discounted the negative, and that as we move forward, it's not as bad as thought. And there's other factors that will help propel what I think is going to be the steepest bull market rally yet.
Yeah. So do you think that the tariffs that are currently being proposed at the moment is really more a negotiating tool? So do you think it's just a way of getting all the countries to the table to be able to negotiate good trade deals? Do you think it's just the way that Trump functions as a negotiator?
I think that's half of it. He would like to see, the parties come to the table and knock down their tariffs. But he's very sincere, and I think means to institute the tariffs if he doesn't get that. So I like I said, it's probably some of both. He sees the tariffs as a way to raise revenues and, give us tax cuts here, um, balance off some of the tax cuts. On the other hand, yes, I think he and his team would like to see um, a freer trade environment out over the world, and I don't know if that's realistic or not. We'll see. Um, I think some of the parties like India and Vietnam are starting to come to the table and say we'll negotiate lower tariffs. But Europe seems steadfast. Canada seems steadfast. Mexico, at this point, I think we're not sure what we're going to get there. And frankly, I am concerned that I think a lot of our trading partners are getting advice from those on the other side of Trump in this country saying, don't give in to him. So, in other words, rather than see what's best for everybody and best for our country, they're trying to block him at everything he's trying to do. And so Canada's hearing from the left in this country saying, don't negotiate with him. He'll have to back down. It's not in the U.S.'s interest for them to do all these things. Same thing on the Ukrainian war. I think Zelensky's listening to the left in this country, is why he first agreed to the mineral rights with Trump, and then changed his mind. I think he's hearing from the likes of Schumer and his gang down in Washington saying, don't. So Trump is not only fighting our trading partners and our adversaries overseas. We're trying to negotiate peace in Ukraine and peace in the Middle East. You'd think he'd have everybody in this country cheering him on with that and trying to help him, but that's not where the politics are right now. The politics are, if we can stop him at every turn, we're going to do that, even if it's hurting our country.
Yeah, he's definitely got a lot to contend with at the moment, and there's a lot of international scrutiny and pressure on him as well.
The good news is he's got a very strong backbone, and his words are not just words. That's why I was saying before, it's yes, they're negotiating tactics, but he will stick by them if the other side doesn't come around. He doesn't. He's smart enough to know he can't bluff. He either has to mean what he says, or ultimately he's going to lose on all those negotiations.
Yeah, and obviously America is the largest economy in the world, so he does have a lot of kind of negotiating power and a lot of kind of leverage.
More than just the largest economy in the world, we have been a open market in most cases to the world, and in the meantime they've all closed their markets to us. That's why he's doing what he's doing, and he knows that we have the leverage because they already have our markets. If we put the tariffs on and they lose our markets, that really hits them hard. We're dealing with closed markets. If they don't change, we already were there. So yeah, all the leverage is on his side.
Yeah. And do you worry that that these tariffs could be an inflationary driver in the market if they're implemented and the cost goes up to the consumer, for example? Is that a concern of yours, or is that something that you're looking at?
Yeah, I don't think so. In the long run, no, because what happens is tariffs will ultimately probably suppress demand, and bring down prices that way. So as you work through the system, no. Initially, obviously, you can have price increases, and it looks inflationary. But and by the way, those tariffs are not going to be absorbed all by the consumer. There's going to be some absorbed by the manufacturer, and some absorbed by the consumer. And the way they work through the inflation indexes, it's not as bad as it may look or may appear. But ultimately, I think the economists, you hear a lot of, certainly our Fed, and you hear from a lot of economists that, yes, this is inflationary. It really isn't. It is initially because you get price bumps, but ultimately kind of sorts itself out, and it doesn't, it's not long run inflationary.
Yeah. And is there any previous examples in history where obviously that's been implemented and we haven't seen inflation?
Well, I think if you go back, I'm not I don't
Yeah.
have the history at my fingertips, but I think if you go back, it's basically a one-time price increase generally. It's how it works. Inflation is an ongoing thing. A one-time price increase boosts inflation initially, but like you said, there are offsets to that as you go along.
Yeah. Okay, and we've seen, I saw a report, I think it was last week, where Goldman said that they said that there was about a 35% chance of a recession in the next 12 months. Is that something that you believe has a high probability of happening, a recession? And what's your overall views on that?
Yeah, my probabilities are much higher than that. I think we will see a recession in the next 12 months. I think we could really be in a recession before the middle of this year. A lot depends, but my whole forecast is that we're in recession this year, moving towards a global bust, and that global bust could happen before the end of this year. So, global bust I define as something. Probably the easiest thing is to call it 2008-9 on steroids. It comes with a big financial crisis, a big banking crisis around the world, bank failures like in 2008-9. The leverage in the system is much bigger than it was in 2008-9. So a recession with even bigger leverage than we had back then means the downturn is likely to be bigger. Certainly the financial side of it is going to be bigger.
Yeah. How severe do you think that the recession will be? Do you think it'll be an extreme? Do you think it'll be a hard landing, or do you think it'll be kind of more of a softer landing?
When I say bust, as I said, it's basically it's a depression-like feel that happens at the speed of recession. So it's not a drawn-out, decade-long depression like the Great Depression, but it does occur. It does feel like a depression when you're in it, and it probably is over in 12 to 18 months. So it's much faster than a depression, but it feels like a depression. Kind of like I said, 2008-9, we almost went over the top in 2008-9. We are over the cliff. If you remember, General Electric almost had to close their doors because the commercial paper market froze up. If the government hadn't acted quickly, if the markets hadn't been opened up quickly, we probably would have seen a bust in 2008-9. This time, I think we go over that cliff and it's worse. So it's more it's a hard landing accompanied by maybe the biggest financial crisis in history. We'll have to wait and see. But 2008-9 was really the biggest crisis. I think this one could be bigger, probably more so in terms of the banking crisis. We'll see it more in the overseas markets than here in the U.S. because the U.S. Banks were forced to deleverage back in 2008-9. Europe banks are in rougher shape this time. The Canadian banks are not what they were in 2008-9. They're in worse shape. Australia, as you know, is very leveraged to the real estate, so they're vulnerable. Asian banks, we know what's going on in China. So I do think you're going to see maybe more of the damage overseas, but the U.S. banks are certainly vulnerable because it's a small world. When you see the counterparty risk, if it happens overseas, it'll come to our shores too.
Yeah, that would be extremely severe. And I think I've seen you mention previously on past interviews that you expect a melt up first before a large crash of those proportions that you were mentioning. Is that still what you're thinking at the moment?
Yeah, I should define melt up because I kind of started the term. I didn't invent the term, but nobody was using it when I started using it back pre-pandemic. Melt up to me is an outsized bull market, an outsized, huge run. We bottomed in October 22 with the S&P at 3,500. So we're up 65%, I think, from there. The Nasdaq's up more than double. It bottomed, I think, at 10,100 or something like that. So it got up to almost 20. So you're talking about in 2.5 years, huge run. And I think we had a leg from October of 2022 when the market bottomed, the bear market bottomed and turned. We had a leg up into October 23. So in that 1 year, you had a big run. You've had an even steeper run from October 23 to February of this year. And then we've just gone through this 10% correction in the S&P and more in the other index in the Nasdaq. I think you're about to start. If I'm right that we retested successfully yesterday, you're about to start the third leg of this cyclical bull market that started in October 22. And I think this third leg could take us to S&P 7,500, Nasdaq 25,000, Dow 55,000, and the Russell, which is probably the one people least believe, 3,300. And from where we're at, those are huge, huge moves. And I think we could be there by this summer. It doesn't have to happen by a certain, within that short a time. But I think it's going to go parabolic. And in a parabolic, you cover a lot of ground in a hurry. It's going to be a very steep, like I said, steeper than the last two rallies, the last two legs. And for example, I think semiconductors, the SMH, I think that can go to 400, which is almost a double from where it hit its lows yesterday. So you're talking about big moves. It will be Mag 7 and semiconductors and tech, but it'll also be value stocks and it'll also be small cap stocks. It'll include an awful lot of groups.
Yeah. Okay, and obviously from your huge amount of experience in the market over the years, how do you kind of see and how do you kind of mark where the potential secular tops could be and where the bottoms are going to be? What kind of key characteristics do you look for when making those decisions?
Yeah, well, at the top, if I'm right about the kind of run we're about to have, you've got a lot of bearishness now. What I call the wall of worry. What I say is, extreme bearishness right now, extreme negative sentiment. Between now and let's say I'm right that it tops out this summer, you could have that go completely 180 degrees the other way where everybody's all in. And you look today and you go, how can people go in, in a matter of 3, 4, 5 months, go from despair and very bearish to I'm so euphoric and this thing's got a long ways to run. That's the nature of investor psychology. When the tape goes up, and this is going to be, I think, the biggest rally, one of the biggest rallies in history, if not the biggest, when the tape goes up like that, it sucks people in. They can talk all they want about being bearish today. You know why they're bearish today? Because they just saw the market go down 10% in a few weeks. When it goes up, 30 or 40% in a matter of months, the psychology is going to flip them around to the other side. At the top, I'm going to be saying it's time to get out. It's, this thing's got huge downside. And I'm going to be getting the same thing I'm getting now, which is you're wrong. You're too bullish. I'm going to be getting in reverse at the top saying you're wrong. This thing has a long ways to run. Even though it's just run 40 or 50%, they're going to be telling me that this is nowhere near the top. That's what you'll see at the top. So it's sentiment that is probably the key thing to watch for at the top and at the bottom, negative sentiment at the bottom. But at the same time, the reason you can get there is because you're going to have the Fed winds at your back. The Fed's probably going to be easing because the economy is slowing. Inflation's slowing in spite of what people think today. The tariff thing will probably be resolved to some extent so that people are not bearish about that. And interest rates, the 10-year, which is what I watch closely, I had called for a head and shoulder top in that this past week. It topped out around 440. I said it could go to 440, 450. It topped out, I think overnight ticked to 440, but during the the trading session got up to say 438 or 9, rolled over, and today it's at 415. So I think you're on your way to 3% and below. I think you could be 2.5% by this summer on the 10-year. That will be a big wind at the back of the stock market.
Yeah. So do you think? So you think that the interest rate cuts and maybe the smoothing out of the discussions over the tariffs, etc., might cause kind of that big next parabolic leg up?
Yeah, it'll start. The bonds move before the Fed. Everybody thinks the Fed sets rates. Really, the market sets rates. So the bond market will bring, as they are now, they're bringing rates down, even though the Fed hasn't moved at all. The Fed will follow. So I think you could see a cut in May, and then again sometime in June or July, and certainly in August. The Fed just stopped QT. They could start QE if the economy gets dicey enough here, but and you do have some things that could cause that. Tariffs obviously are going to cause some pain initially. Interest rates having been up for a while now have hit housing and auto sales. So in the next few months, the economy may not look very good, and you could have the Fed feeling the need to start pumping some liquidity, which they haven't done. Everybody thinks there's a Fed put. Powell's made it pretty clear he's not watching the stock market. He's watching the economy. And if he starts worrying that they've over tightened or that they need to ease, I think you'll see them move the other way. So I don't worry about, the press conference after a Fed meeting and what did Powell say today, or what does the dot plot say. They can change on a dime if the economy gives them the reason to change. So, and that's what I think we're moving towards. Once you have the Fed's wind at your back, meaning they're easing again, that can drive cyclicals, because people look over the trough and say, oh yeah, next year earnings are going to be much better. That will drive interest sensitive, because rates will be coming down, and it will also drive growth, because that's interest sensitive. So I think, which is tech in particular. So I think you're going to have a very broad rally. It will also finally jumpstart the Russell, which is a small cap index, which has really lagged. It had a nice run, I guess late last year, and then stalled out, or from middle of last year to late last year, stalled out, and has corrected pretty sharply here. But I'm calling for 3,300 on the Russell. From 2,000 to 3,300 is basically a 65% run.
And you think that the Russell will be helped by more liquidity coming into the market, and people going further out into the risk curve?
Yeah, I think that, and it's certainly rate sensitive. So as rates come down, that'll help too. And just the sentiment that we now can look over the trough, because whether right now people think it's soft landing, but if they start worrying that it's even more than a soft landing, the Fed being at your back, you can begin talking about 9 months out, recovery. So next year, all of a sudden, you can start looking at better economy, better earnings, and that will favor small cap, which is very domestic.
Yeah. All right. And do you think we ever go back to a time, obviously it happened for quite a long period of time, where rates went to zero and stayed at zero for a while? Do you think eventually they could get back to zero, or do you think that they're likely to hover around low levels but not zero?
Yeah, so we were at zero, and obviously hit our bottoms in rates back in the pandemic, back in 2020, March 2020. The 10-year, I think, got down just below 0.40. I am probably the only one on the street calling for lower lows on rates. I think you could get the 10-year down to zero, not just short rates, but the 10-year down to zero in the bust, because the bust is going to be so bad, it's going to require every central bank to print money like we've never printed before. And doing QE or printing money means you've got to buy every bond that's out there to get the kind of money that they're going to need to pump into the system. So I think you're going to have one more move down in rates, up in bond market to new highs on the bond market, new lows on rates. That'll be the secular top in the bond market, the secular bottom in rates. And then from there, probably, towards the end of the bust, you'll begin the march in rates back up such that you'll go from a 0 10 year, and that might be, first half of next year, to, I think, potentially 15 or 20% 10 year by early next decade. So, because with all the money the response to the bust will be massive money, to the tune I've said many times. Again, this is just seat of the pants. We did 5 trillion in the response to the pandemic, QE, or expansion of the balance sheet, Fed's balance sheet. I think we could see 20 trillion in response to the bust, and proportionally similar from each central bank around the world, because it's going to be global. So you're going to have massive money out there, and it will, with a lag, probably a year and a half lag, it will start an inflation cycle bigger than the early 80s, an inflation cycle we have not seen in the post-depression period. And so if you can see I'm predicting 25% inflation by the early 2030s, not necessarily 2030, but the early 2030s. If you see 25% inflation, you're going to see 20% interest rates or higher. And that becomes really problematic. But the next cycle, the cycle that follows the bust, will be driven by that massive money, will be driven by industrial expansion as we reshore here, and you have to build up commodity supplies, et cetera. It's going to require a lot of industrial spending and industrial expansion. You're going to have an industrial recovery, and it's going to be a very big commodity super cycle. So you'll see commodities go through the roof. I think oil can get to $30 in the bust because demand falls through the floor. But from that bottom, I think oil could go to $500 in the early 2030s.
Well, yeah, I guess because everything will every commodity will strengthen against the dollar, right? Because
the dollar's going to be going down, so that'll be part of it. But the biggest part of it will be the demand, because you've 20. I don't think people can wrap their mind around these numbers. We had an $875 billion Fed balance sheet back in 2008. All of a sudden, it's going to be 30 trillion, if I'm right. That's 20 trillion of new money pumped in, along with proportionally similar around the world. So whatever that is, 50, 60 trillion, whatever it is. That's huge in terms of going into a system that's built on much, much less demand than that's going to trigger. So the demand goes through the roof, and you don't have the supply to meet that demand. Prices go through the roof, and you get inflation. So it's, it comes out of the macro. It comes out of the response to the bust. And people say, well, why would they do that if they know it's inflationary? They will be deer in the headlights, scared to death, looking at a free-falling financial system and doing whatever they can to stop it, which means pumping money like crazy.
When we talk about this bust, I think it's quite hard for people to get their head around how big the bust could actually be, and what sort of levels we're talking. Are we talking the Great Depression levels? Are we talking 2008, 2009 type of bust?
Yeah, it's something in between there. That, like I said, I call it 2008-9 on steroids, just to try, because that is the most recent example we have, and that was pretty scary and pretty rough financially. So I think this one exceeds that in a lot of ways. Economically, I'm not sure. We'll probably see double-digit GDP, but again, it's fairly short. It might last 12 to 18 months. So it's not like you're dragging through it like the 2030s, 1930s. It's fairly short, but in that short time, I mean, look how uncomfortable people are about a 10% drop in the equity markets in the last month. If you have, and I'm calling for an 80% bear market, peak to trough. If you have an 80% bear market that lasts 10 months, people are going to be distraught. really distraught, right? So, and if that's accompanied by loss of jobs, it's accompanied by 30 or 40% drop in real estate prices, it's going to hit people pretty hard. Consumer spending is going to drop like a rock. Housing is going to drop hard. So you've got a lot of things out there that are going to, and while you're in it, it feels like you'll never come out of it. You will, because of that money, you will. But while we're in it, people are going to feel very, very nervous.
Yeah. The sun always comes up again, doesn't it?
Yep.
Yeah. Okay. And I wanted to talk to you as well about gold and what's happening in some commodities. Gold has obviously had a very good year. Looking at new all-time highs have happened quite a few times this year. What's your viewpoint on gold? Why do you think it's performed so well this year? And also, what's your kind of outlook for the future for gold?
Sure, gold has done great. It's bottomed out several years ago at 1620, and so we've basically moved up, not quite to a double yet, but we're on our way to a doubling of the gold price in just a matter of years. So I have a target of 3,400. I have a new letter coming out in the next week, and I'll probably raise my target on gold in that letter. We're not far away from 3,400, and I think there's still, a good runway ahead. So I think gold probably wherever it goes here between now and the bust. I think it's going to look very good, but in the bust, I think gold could trade back down near where it broke out. It broke out at 2,100, a couple of years ago, or a year ago, whenever it was. I think we could go back to that breakout point. So let's say if we're at 34, let's say my 3,400 number stands. From 3,400 to 2,100 would be basically backing up by a third, maybe. If we go higher, it might be a bigger backup than that, 40% backup, for example. But so in the bust, even gold will get hit. But if I'm talking about an 80% equity bear market and gold goes down 30 or 40%, that's outperformance. So it'll hold up better for sure than the equity market, but it's going to get hit. And people need to know that there's a huge bull market after the bust in all commodities, including and metals, including gold and silver. I'm calling for 20,000 gold early in the 2030s. So if the bust is over second half of next year, or the market starts discounting the end of the bust second half of next year, gold could run from, let's say, 2,100 to 20,000 in the ensuing 6 or 7 years or less. So that's what I see is a huge bull market in the metals. Silver, similar thing. Silver, I think I have a $75 target right now for pre-bust for this year. I would not be surprised if in the bust, silver traded back down to where it is now or below. So let's say silver went from 75 back to 30, or 32 or 33. That's probably a 60% drop, whereas gold might drop 40. So, but then on the post-bust, in the post-bust market, silver could go from, let's say, 30 to 500. And that same period as gold goes to 20,000. So the commodities are going to be king. Copper, same thing. I see copper going from, I have a $6 number I've had for quite a while. When copper was down under $4, I was calling for $6. In fact, I think it was down near 3 when I was saying 6. It got up to 5 and change here and has backed off a little bit. I think it's going to run to 6 pre-bust, meaning probably by the summer. And then in the bust, it could even go all the way back to $1 because it's so economically sensitive and housing sensitive and tech sensitive, et cetera. So demand could fall off a lot and you could see it really get hit. So, and then from there, and I don't know if it's going to $1, maybe it goes to 2, but somewhere in there, from there, copper's going to go through the roof during the post-bust commodity super cycle. It might go to $20 or higher. Who knows? So the metals, all the metals look great, and I don't follow them closely, but it would include, nickel, zinc, tin, all of those things too, particularly in the post-bust recovery. And the miners, which accompany the gold and silver, I believe gold miners have, like Newmont and Goldcorp, and smaller ones as well, have a long way still to run. I have a target on GDX, which is the larger cap gold miners, of 65. I have a target on GDXJ, the junior gold miners, of 100. And if anything, I think those numbers, and those are pre-bust numbers. If anything, I think those are low. The silver miners have lagged. People are frustrated because every time they start to go, they correct again. But I have a target of 35 for SILJ, the junior silver miners, and SIL, I have a 75 target. So there's plenty still upside there. They should outpace gold in the next several months, which is typical in a bull market. So they've taken their time getting here, but I think they're ready to run.
Yeah, I guess with the miners, there's a big kind of lagging effect on the stocks, right? So so obviously gold leads, and then it does take some time for the gold miners to start to build up some momentum.
Yeah, I think the prices have to get to a bit higher levels to convince people that these companies can really coin money. They've had high costs and things that have kind of eaten into their margins. But at some point, if gold and silver move like I think they're moving, well, gold is already, and if silver starts catching up here, I think you're going to see that outpaces any cost increases. And all of a sudden, people get more excited about the earnings in the miners.
Yeah. Okay. All right. That's an excellent summary. So, David, how can people find out a bit more about you and find out a bit more about your newsletter and other bits of information that you put out?
Sure. Yeah, those are basically my two ways of communicating with people. I'm on Twitter or on X every day. I get a lot of questions, too many repetitive questions, but I get a lot of questions. And particularly in weeks like we had this past week where the market's going down, everybody gets nervous and they want their hand held and they want to know, where's it going, when's it turning, et cetera. And I keep reminding them I'm a macro strategist, not a trader. I'm not trying to call every tick and every day, and yet they need their hands held, so they're out there a lot. But I'm on there every day answering questions, making comments, and then I also have, and my handle is at Dave H Contrarian. So at Dave, not David, at Dave H Contrarian, and I also have a quarterly investment letter, macro letter that I put out. I've been publishing it since 2000. It had been an institutional letter that went out to institutional clients, but a few years ago, I decided it was very readable for retail folks, and I've been making it available for them. So anybody interested can direct message me on Twitter or on X, and I'll provide details. It does come with a cost, and it's an annual subscription fee. So anybody interested, I get people after some of these interviews will DM me and say, sign me up for your letter. They think it's free, and it's not free. But it is something I've done for a long time. I've got a good number of subscribers, and they tell me it really adds flavor to what I do on X, in terms of I can write in more depth, my rationale, etc. So it's available for those who are interested.
Okay. Thanks, David. Definitely check out David's resources. He's obviously got a lot of experience in the market, and he puts out some really good information pieces. So, yeah, definitely check that out. And I want to thank you, David, as well, for a really great discussion. I've had a really good time. Time is short. I think sometime in the future we can go into a lot more detail and go more into the weeds. But I've really enjoyed our chat today, and I hope we can do it again sometime in the future.
Yeah, thanks for having me, Steve. Yeah, I think the next 6 months are going to be very interesting.
Yes, I do too, as well. I think there'll be a lot to watch. All right. Well, thanks very much, David, and hope to speak to you soon.
Okay, you take care.